The transfer pricing process consists of answering three key questions. Firstly, are there cross-border transactions? To determine this, we need to apply the cross-border test set out in Section 815-120, subsection 3. The conditions will satisfy the cross-border test if they meet the overseas requirement, where we have an Australian resident transacting with an overseas entity. For example, let's consider an Australian resident company that purchases vases from a related company which is a resident company in Singapore. The vases are purchased as inventory and sold in the Australian company's retail stores for $120. This is an overseas transaction between two entities and the cross-border test is satisfied. Secondly, we ask, are the actual conditions different to arm's length conditions? That is, what are the actual conditions? What are the arm's length conditions and do they differ? The actual conditions will simply be the price for the actual transactions or agreements. Difficulties arise when we try to determine an appropriate arm's length price for comparison, as the conditions need to be sufficiently similar. Arm's length conditions are defined in Section 815-125, subsection 1, and are the conditions that would be expected in a transaction occurring between independent entities operating under normal market conditions. But the conditions have to be comparable to the actual conditions. Guidance is available in the OECD Transfer Pricing Guidelines for Multinational Enterprises and Tax Administrations and sets out 5 methodologies that can be used. So for our example, we compare the actual price of $100 per vase paid by our Australian company to the arm's length price, which was determined to be $60 per vase based on the comparable uncontrolled price method. It is clear that there is a $40 discrepancy between the two prices. Finally, we ask, is there a transfer pricing benefit? That is, does a transfer pricing benefit arise through decreased tax payable in Australia as a result of the difference between the actual conditions and the appropriate arm's length conditions? It is pretty clear here that there is a transfer pricing benefit, as the Australian company will have a deduction of $40 more per vase than would otherwise be expected, and this results in a much lower taxable income and tax payable in Australia. The increased profits won't be of concern to the related company, as it is a resident company in a jurisdiction with significantly lower company tax rates. So, if there is a transfer pricing benefit, then the Commissioner will substitute the actual price with the arm's length price for taxation purposes. This includes both taxable income for income tax purposes, as well as capital gains or losses that attract CGT. In our example, the arm's length price of $60 would be substituted and used to calculate taxable income for the Australian resident company. To recap, the transfer pricing tax regime is in place to rectify cross-border transactions between Australian resident entities and non-resident entities where a transfer pricing benefit, that is, a tax benefit, results in less Australian tax being paid.